virtual Penn campus here. So Jonah did a great job kind of describing in a lot of ways what my first question was going to be, but I thought it might be good for the audience just from a context setting perspective for you to just talk a little bit about your investment philosophy and the evolution of that philosophy. And then once we have that context, we can go into some deeper topics.
Sure. My investment philosophy really started with my self-education investment business. I went to Harvard Business School, a competitor to Wharton, with a plan to learn about how to become an investor. But I sent in the tuition and I showed up on campus before opening the course catalog. And back then there was such a thing as a paper course catalog. And I'm flipping through, hundreds of pages, and I'm looking for the class on how to be a good investor. And it was not such class. Okay, so I kind of designed my own self-study program. One of the early books that got me interested, I read Ben Graham's Intelligent Investor, kind of a classic. I then sort of learned about Warren Buffett, started following Buffett, and I would say I followed a somewhat analogous path. If you think about Buffett in the mid 1950s, and you go back and read the Buffett partnership letters, he really was an activist hedge fund manager back then. He won't talk about that now. But about 15 years later, he was managing $100 million, about 25 million of it was his. Life was good. But he chose to, basically liquidate that entity. And over time, he ended up control of Berkshire Hathaway. So he gave up the right to receive 25% of the profits on this hedge fund pool. And he traded it for $100,000 salary, no stock options, and a public company. And you could see the migration in investment strategy over time, in that the quality, if you will, of the businesses he invested in improved dramatically, over that sort of history. And I would say my sort of education was kind of similar. Kind of early on, I was focused on, buy $1 for 50 cents and let there be a catalyst to cause that gap to narrow. And often we felt we could be a catalyst. And over time, more and more I came to believe that you want to own businesses that you never need to sell. And to find a business you never need to sell, it's got to have it's got to be a great company. It's got to have an absolutely defensible market position. You can't have the risk of a couple of Wharton students working in a garage off campus and coming up with some disintermediation, a company that will put you out of business. So I would say our main focus right now, and I think forever, will be buying what we call the greatest businesses in the world. What you might think of as a super durable growth company, where the risk of being pushed out of business by technology or other forms of innovation is very, very low. And the business earns very attractive returns on capital, ideally not particularly capital intensive. And of course, you want the best management team, running a company like that. So that's job one. And job two is kind of figuring out, and by the way, that job is the hardest one, figuring out, particularly in the world that's become a lot more dynamic than it was even a decade ago, right? The ease of, you have an idea and you want to go into business, and you don't need to finish your college education, let alone a graduate school, and you can find an unlimited amount of capital looking to back talented young entrepreneurs pursuing, a business idea to disintermediate an existing successful company. So trying to figure out which businesses have what Buffett would call the widest moats, I would say, is a very, very difficult thing, and that's kind of job one. Job two is to make sure you buy that business at a price that makes sense, and then job three is, to the extent the business is not being run optimally, how can we be helpful in making that the case? That, I would say, in sum, is the strategy. One little correction from Jonah. He said we built this market hedge. We're invested 27 million, and we realized a profit of 2 million. And we actually invested 27 million. We invested a profit of 2.6 billion. Yeah. If it had only been 2 million, it wouldn't have been as notable. That would have been a loss. But part of our strategy is also thinking about what risks exist, so-called black swan type risks that could surprise us all, and we find ourselves in a position where there's been some kind of permanent impairment by virtue of a event outside our control, and can we figure out a way to hedge those risks? I would say that's the other part of the strategy.
That's incredibly helpful. One of the things is I sort of have followed you for a long time, and your activism in the early days, often appeared, you find these companies where there were these huge gaps between what they could be and what they were, and you tried to be a catalyst for change. But as I look at your portfolio right now, I mean, you've got some great brands in there. I mean, these are companies that have staying power and sustainability and so forth. So as an activist, how do you actually influence companies like this? It's got to be a little bit different than the early days.
So I would say in the early days of Pershing Square, and even before that, Gotham Partners, a good example might be Wendy's International. So Wendy's, the hamburger chain, in the 2004 context, the company was trading at an enterprise value of about $5 billion. And they owned 100% of a company called Tim Hortons, which is sort of the bit of, you might call it the Starbucks of Canada. And Tim Hortons had $450 million of operating income, and I thought was comfortably worth more than $5 billion. So you could buy Wendy's in the stock market for $5 billion, and if you subtracted out the value of Tim Hortons, you came up with a negative number. And all they had to do was separate those two companies and create a lot of value. So we bought 10% of the company, we convinced them to separate, they separated, the stock doubled, and we sold. And that's great, except you have to find another one. Okay. And in a competitive world, as people saw that strategy become profitable, everyone became a shareholder activist, including the CEOs of a lot of businesses, where Goldman Sachs or Morgan Stanley would show up and say, "Hey, you're vulnerable to a shareholder activist coming and telling you what to do. You might want to preempt them by doing it yourself." And the Goldmans of the world built a business trying to find opportunities, like that. And but the good news about each of those experiences, one, we learned a lot, but two, we built a brand, if you will, as an influential shareholder. And the result today is that if we take a stake in the company and we literally do nothing, they will do everything they can to improve their business, so they're not at risk of our, if you will, pushing them to do something. And it's led to very, I would say, what I call partnerships with very talented management teams, where we have a completely open dialogue. We share with them openly what our thinking is, and they respond. And they say, "Look, this is a great idea. We're going to do it." Or they say, "You know what? We disagree for the following reasons. Let's figure out who's right, who's wrong." And that has really become, I would say, the modern day management's approach to someone like us. And that's made our so-called activism much less noisy and visible. It means I would run a proxy contest in 4 years. I hope to never have to run another one. Life is good. And we've had the best performance in the history of the firm, over the last 3 years. So we have a public entity that represents about 90% of our capital. So you can really track our progress. The NAV of that public entity, I think, was a little under $15, about 14.5. I happen to know the date because it was the bottom, March 28th of 2018. So here we are, a little less than 3 years later. NAV is now 49, right? So we've had the best period of performance, and I've done the least in terms of I haven't had to run any proxy contests. I've just found some super talented management teams, and we work with them the way you would ideally like in a partnership, and it's been a good experience.
Yeah, that's great. So I want to build on that a little bit, and obviously, in both your career and mine, we've seen two black swans in a relatively short period. So you were right in the heart of the GFC, as was I, and now of course you're navigating this. Before I come back to some of your portfolio companies, I'd love to hear just how you contrast the GFC to the current situation, and what we can learn from those differences.
Sure. So going into the financial crisis, you had this sort of explosion of kind of novel credit instruments that spread risk around in the system to the people who were least in a position to bear that risk. So you had these subprime CDOs and synthetic CDOs, and you had bond insurers and banks and other people where there was a bit of a, pass the risk. And really the most naive person who charged the least for the risk ended up with the exposure. And consumer balance sheets were in a really bad place. And corporate balance sheets were not in a particularly good place. And then we had this credit explosion that catalyzed a real recession. And it was a long climb out because the backdrop was overlevered companies, over-levered balance sheets, over-levered consumer, right? People had refinanced their mortgage and extract these sort of cash out refinancings, extract every penny. Compare, here we are, it's 11 years later. And the difference is, I would say, consumers are in one of the best places. Now, again, I'm speaking for the employed part of the population. A lot of people lost their jobs during this period. And, but if you kept your job, able to work from home, etc., during the last period, you're going to come out stronger from this pandemic than ever before. Why? Because you haven't spent any money, because a lot of stimulus money's gone into the economy, because your investments have actually done pretty well. Your home prices are kind of near all-time highs, above all-time highs. There hasn't been the same kind of level of cash out refinancing activity because of changes from a regulatory and other point of view. And you also have what I would describe as animal spirits. Every one of us, working from home, if you haven't already booked your, vacation this summer, you better, because there won't be any rooms left, at hotels, or if it's the wedding you've postponed, or the graduation you didn't have. I mean, people are going to celebrate like it's 1920s all over again. So I think so this combination of enormous liquidity is pumped into the system. So, Trump's almost $4 trillion, another $1.9 trillion from Biden, what's likely to be what sounds like a several $1 trillion infrastructure plan, an extremely accommodative interest rate environment, consumers with approaching a couple trillion of excess savings, and then the desire to spend money and go out to eat and travel and do this other stuff, you're going to see explosive recovery in a way that's very, very different from before. And I think the biggest risk of this is more on the interest rate side and on the inflation side. You're seeing a little bit of that in the markets kind of recently. And actually, interestingly, that was the black swan risk I was concerned about. So in December, January, I did something very similar to what we did in March of last year, is for a tiny amount of money, I bought an insurance policy and rates going up. And we spent $170 million, about, let's say, 1.5% of our assets or so, or 1.4% of our assets. I should have spent more. And so we spent $174 million. Today, it's worth $620 million, just a few months later. And the 10-year is basically almost doubled in terms of the rate. And I still think there's a long way to run in terms of rates. But I think it will be a very different kind of recovery for all those reasons.
Yeah. I actually, at a macro level, tend to agree. As you're thinking about, so, you're looking at your portfolio, not just your portfolio companies, but you also come into contact with a lot of great management teams. You also come into contact with some not so great management teams. I'm interested in what you've seen the best teams do in terms of actually navigating the pandemic. Because, today I agree, we're all feeling pretty good right now. Go back 9 months, it was a little less certain. There was a lot more fear, a lot more uncertainty. What did you see the great teams do?
I look at examples in our portfolio. I mean, think about a business that was impacted dramatically. Hilton, right? So Chris Nassetta, super talented CEO, was hired by Blackstone when they took Hilton private, right, in 2007, right before the Great Recession. They levered up to buy a hotel company, and then boom. And I think that is a battle testing experience. And so when COVID happened, he was prepared, not for precisely the same thing, but he knew a lot about how to rein in his cost structure, fortify, if you will, the balance sheet, and set the company up for success. And he's really done that. Going into Hilton stock was 110 probably in February of last year. It's today 125. And last year was the worst year in the hotel industry. It was worse than the financial crisis, absolutely worse. But they're going to come out stronger. And, they're leaner, they're very well capitalized, and the market's going to recover. It's a great example. Starbucks has done a great job. And Starbucks had the benefit, if you will, of having a very large presence in China. So when COVID hit, they had early experience, and they could apply that experience, in the U.S. And so they've done a really great job. If you think about Starbucks' business, people go get their coffee on the way to work. Well, if you're not going to work, how do you, when that's a most important day part for the company, and they've just done a great job with digital and delivery and, accelerating the drive-through and having people run around with these little handhelds taking orders, and just to manage through this period, and they're coming, they're growing again, and going out and getting a cup of coffee. There's gonna be a lot of that happening soon, I think.
Yeah, it's interesting because my sense in some of the companies I'm involved in is what people did really well was they dealt with the here and now intensely, get either get your balance sheet in order, or start to make the changes you need to be more delivery oriented if you're a restaurant or whatever. But it's been interesting to watch how companies have also positioned themselves for what I would call it big moves coming out of this. Are you seeing the same thing? Are you seeing people actually take advantage of this time to actually create more competitive differentiation?
Yeah, look, I think the downside of this period, this is a topic that, is obviously a very important topic for the country, for the globe, but we had an income inequality problem going into a pandemic that's obviously been made, kind of worse as a result of the pandemic. But there's also a corporate inequality problem, if you will, in that the dominant company, the investment grade dominant companies, were able to access capital during this period. So if you're a travel company that's a mom and pop, you got decimated during this period. If you're Hilton, you're going to take market share. And Lowe's, another example of the companies did, the home improvement company did a fabulous job. And everyone's sitting at home. You're sitting at home and you have to build a home office, and by the way, the kitchen needs a renovation, and I got nothing to do, so I'm going to have a victory garden. So, but just adapting, and that is an opportunity to build mind share, improve your customer, your digital experience. Lowe's had a horrible kind of internet presence. Fortunately, they kind of launched a new version in February, so they were kind of very well set up, for recovery. A company like Agilent, Agilent is a scientific equipment company. Oh, we're getting feedback from somebody. But Agilent, if you can mute your line, if you don't mind. Agilent, what they do is they sell scientific equipment and supplies, and then they maintain these labs. Well, maintaining a lab is a harder thing to do in a COVID period. So they figured out a way to help their labs through a basically FaceTime digital offering, and their customers really liked it. And so that, of course, instead of getting on a plane or having to drive or show up or whatever, they're managing their customer in a better way. The customer's happier and it costs them less. And so I think pretty much every dominant company, well-run, great company, and that's kind of our strategy, as I talked about before, is going to take market share, is going to improve margins, is going to build customer loyalty, is going to have more people in the loyalty program. We're a company like Starbucks or Chipotle, another company did an incredible job during this pandemic. They went from 20% digital to 70% digital, and even with their stores largely reopened, they're at 50% digital. So they if you think about the impact on the company's average unit volumes for now having 50% of their sales, they found a whole bunch of customers they didn't have before. Dinner day part customers. Chipotle was not something where mom picked up the phone, or not picked up the phone, but opened her web app and ordered dinner. But people got tired of ordering pizza, so so Chipotle did a good job, and now they have a base of customers that they can sell to, even as the world gets better. So definitely seeing that from this experience.
It's interesting. Chipotle, my former colleague Gus Sauter, Vanguard's chief investment officer during my time at Vanguard, favorite restaurant on the whole planet. And watching, wherever we went, there had to be a Chipotle. So watching the pivot of Chipotle during this, it was one of those things I happened to be watching it because of Gus, not because of, what was going on in your portfolio, but it's been amazing. They've done an amazing job. I mean, it's, if you
that was our really most intensive activist investment, if you will, of the last 5 years, where we bought 10% of the company. They were going through a very difficult period. It's hard to even remember, but they had a food safety issue. The stock was down 50%. Right. And they were very open to help because they needed it. And they gave us, basically we switched half the directors. We added 4 new directors to the board. 2 were affiliates of ours. 2 were directors that we kind of mutually supported. And those directors recruited Brian Niccol to be CEO. And it just shows you how much value can be created. The stock at the time was $265 a share when we hired Brian Niccol, and it's $1,400 today.
Yeah,
less than 3 years
done
later.
An amazing job, and I want to come back to that in a minute, but I see Jonah on screen, which means we've got some great questions coming in from the audience. So we'll take a pause and hear what our audience wants to talk about.
Awesome. Thank you so much. Our first question is from Tyler Balakal.
Hi, Bill and Bill. Thank you both for being on. Really appreciate your insights and speaking with us. I had a question for Bill Ackman. You mentioned earlier in the talk about your strategy with Tim Hortons and Wendy's and the gem that you found in Tim Hortons. Can you give us an insight into how your process into finding these kinds of opportunities? How do you kind of beat the market, so to speak? What do you do different from them that you get to it first, or find something that they don't? That'd be very helpful.
Sure. So people buy and sell stocks and securities for all kinds of different reasons and have all kinds of different timeframes, right? You've got quantitative investors that use AI and computer algorithms, and they're constantly buying and selling in companies with factors, many of which have nothing to do with fundamental, factors about the value of the business. We have the benefit of having on a very unusual capital base in that, as Bill will tell you, the investment management industry, the spectrum from, call it index fund to mutual fund to hedge fund, what's unusual about Pershing Square is almost 90% of our capital is in a public company. The employees of Pershing own 25% of the company, and it takes a 75% vote to liquidate the company. So it's as close as you can get to what people might call permanent capital. And it allows us to have a time frame for our investments that is different from your typical, and even mutual fund manager literally has daily liquidity, performance pressures. And there's something that people call time arbitrage, right? If you could take a longer term view than the next guy, there are opportunities that you can pursue that they have to avoid. Imagine a business that's, for example, really investing over the next several quarters to build value over longer periods of time. The result will be to impair their earnings, and the stock will look expensive relative to their competitors as a result. And a lot of investors would skip a situation like that and wait for the earnings to recover before building an investment. So I think, look, there are plenty of super talented analysts and a lot of very smart people in this business, a lot of very successful firms. But in our case, I think we have a strategy that makes a lot of sense, and we're able to implement it because we've got a capital structure.
Took all the PSCH people in there, fucking assholes.
So you can have a great long-term strategy, but if your money can disappear every quarter or every day, it's challenging to implement. And if I look at the firm over the last 17 years, we're approaching our 18th year, the more stable our capital base is, the better we've done. And now we've achieved this, really what Buffett achieved in the late 60s, which is he came out with control of a public entity that had permanent capital, and he could take a very long-term view. And that, I think, has inured very favorably to his shareholders. And I think the same will be true for ours.
Our next question is from Matthew Curran.
Hi, Mr. Ackman. Thanks a lot for coming to speak with us today. My question is, how do you know when to part ways with a losing position? For example, in the case of Herbalife, even when you believed in your core idea and thesis, how do you think about just deciding when to pull your money and thinking about, okay, this market just isn't going to make this position realizable? Thank you.
Sure. So I think the answer is really different than if you own something than if you're short something. People think of Pershing as a short seller largely because of that Herbalife investment. And yes, there's a Netflix movie and it certainly got a lot of publicity. But we probably it's been years. Our last short was Herbalife, and that's kind of I never intend to short another stock. As evidenced by your recent experience with GameStop, stocks can trade at any price in the short term, high or low. And that's not as troublesome if you own something. It's very frightening if you're short something. And basically what happened to Herbalife is Carl Icahn bought a third of the company. The company bought back a huge percentage of the outstanding shares. And the amount of float, the actual public float, once you took out, frankly, the index funds, Vanguard and others, which are not really part of the float because Vanguard is effectively a permanent investor. Many of these businesses, it was a GameStop-like situation with a very, very small float, and we had a big short position. And if you find yourself in a position like that as a short seller, you exit immediately. that's basically what we did. What's interesting about Herbalife, people talk about ESG type investing. I can make the argument it's our most ESG investment, even though it was a short, because our highlighting the problems with the company led to a Federal Trade Commission investigation, a $210 million settlement with a group of consumers who got harmed by Herbalife. That led to a foreign corrupt practices investigation that led to a settlement of $130 million. All of these things you would think normally would make a short investment work well, but you can be entirely right on a short and you can lose your shirt because of technical factors. So in that case, one, I don't recommend short selling, and two, you find yourself short something where the float is shrinking, exit as quickly as you can. On the long side with us, if we own a great business at an attractive price, we're not really affected by what the stock price does. We're affected by the facts. So if something changes about our thesis on the business, we learn new information that's inconsistent with the thesis, that causes us to reassess what the business is worth, or the stock price rises to a level where the return to the owner is just well below what we think of as our return expectations, then we will exit to find something that on which we can earn a more attractive return. But hopefully it's not because we've learned new information. Hopefully it's because the stock price has increased to a level that it's just, it's an 8% return from here. It's still a great company, but we can find a better use of the money.
Thank you for both of those questions. Mr. Ackman and Mr. McNabb will now continue their conversation, and we'll return for more Q&A shortly.
Thanks. Those are great. Bill, I loved your description of the time arbitrage and the permanent capital and the alignment. It's really interesting that indexing and what I would argue, among the most successful active managers on the planet, actually, philosophically, we think about it a lot the same way. I think time is your friend. And, for us, as we've studied active management, people think because we run so much index money, we don't think active can work. What we've seen is very long-term positions, very concentrated portfolios. It's the best way if you're going to try to beat the market to beat the market. And it's interesting how two philosophies that are so juxtaposed actually are founded on sort of similar principles, time frame and capital structure. Really interesting.
Totally agree, by the way.
Yeah. I want to go back to, I do want to talk about some other market stuff in a minute, but I couldn't let pass. You were talking about, the CEO replacement at Chipotle. I think the audience would love to hear, as, again, an incredibly successful investor, what do you think makes a great CEO?
Sure. So among the things we've learned, bringing in a CEO to a new situation is, we brought Hunter Harrison in to be the CEO of Canadian Pacific. So we took, executive who had turned around the worst railroad, what was then the worst railroad in Canada, and made it the most profitable railroad in Canada. And then we brought him in to do the same thing with Canadian Pacific. And the risk reward of that is so attractive because you have a proven CEO with domain expertise stepping into a business he completely understands with an aura around him of credibility, which enabled him to change the culture of the company and make the necessary changes. So I do think that's a great example. Brian Niccol. So we took Brian from Taco Bell to Chipotle. And I think, he would tell you that, he wouldn't tell you this when he was a Taco Bell CEO, but he would take his family to Chipotle, probably wear a hat and glasses so that no one would see him when he was Taco Bell CEO. But you're taking a guy who was brilliant at marketing and running Taco Bell, which is a subsidiary of Yum, and then to a place where you really like the food. And I think, so again, bringing an executive with domain expertise, but kind of more general is you want people who are, high energy, super passionate, motivated for beyond economic reasons. They love what they do. People who I'm very open to someone who prefers someone who's been through a battle and lost, made some mistakes and learned from them. I think that, it's you can't be a successful CEO unless you're confident, but you can't be a successful CEO unless you're also humble. And you have to have a balance between those two things. And the same thing's true for investors. And if you've only succeeded, there's a risk. And one example of that was Ron Johnson, who I recruited along with the board to go from, he ran the Apple retail store, and he came to JCPenney to turn around the company. Anyway, convinced him to leave Apple, you can imagine. And this was a guy who had never failed. And that made him less open to data that was suggested that the strategy wasn't working. And it also made him want to risk the entire company on a strategy that was unproven. And I think, a certain degree of humble. Now, Ron Johnson, who I'm a fan of, and I really like him, and I was supportive of him during that period, is now running a very successful startup. And had I had the opportunity, I probably would have invested, because he had the opportunity to be humbled by JCPenney, learn from that experience, and then succeed. So those, I think, are some of the key. Obviously, integrity is everything. It's got to be somebody you completely trust, someone who tells you the bad news first. The good news will take care of itself. But the kind of things you'd want in a friend, in a partner, and a spouse, at least for me, so.
Yeah, no, again, that makes sense. I want to pivot to something actually you referenced in when you were talking about Herbalife. You mentioned ESG, and I'm watching this phenomenon both inside the boardroom as well as as a former investment person. It's one of the more profound sets of changes I've seen, and it really, if you sort of elevate the topic to stakeholder versus shareholder capitalism, and and you've written and spoken about the topic pretty extensively at different times. I'd really love to get your take on how you're sort of framing it in terms of this whole stakeholder versus shareholder and how ESG fits into it. I know there's a lot there, but it is one of the huge trends right now.
Sure. And what's interesting is what's driving a lot of the trend is the growing amount of capital that is considering ESG factors and allocating their money. And so what's motivating a lot of firms is, okay, I should raise a ESG fund, or I need to be more good with ESG considerations, otherwise I'm going to lose a mandate. And the benefit of not raising money, we're out of the business of raising money, is we're not trying to do something to appeal to some particular audience. And pre-ESG, we always thought of these considerations. What I mean to say is, you want to own a business that society wants to succeed. It's really hard to succeed if the entire world doesn't like you, your customers aren't excited about you, you're causing economic harm to others, or pollution, or obesity. Make your list of issues, and it's complicated, and I'm happy to share sort of my thinking on it. But we've never invested in a cigarette company because I just don't like the products. I've never invested in Coca-Cola or Pepsi because I think these are businesses that at the end of the day, sugar water is causing a lot of harm, a lot of health and other harm. But we're not perfect. And I look at our least successful investment ever, and it was a company that clearly had, and not to an extent we understood, Valiant was driving the prices of its drugs up in a small segment of its business, but in an egregious way, and a failure of our due diligence not to realize it. But that basically took the company down. So I think there's actually pretty close alignment between being pro-shareholder and being pro-ESG, right? Start with governance, right? Clearly, good governance is the G of ESG. Without good governance, it's hard to succeed. So that's an easy one. Again, think particularly today, think about consumers. Do they want to buy from a company that is causing, environmental harm? And the answer is no, right? Certainly, the younger generations are much more focused on these factors. So again, it's in the interest of growing your revenues that you cause the least amount of environmental or societal harm. And then, so I just think, if you're CEO of a coal company, it's tough. Okay, I don't know what to do other than extract as much cash as you can and reinvest it in solar or wind or some other form of a better form, a cleaner form of energy. But we only need to invest in a relative handful of companies. One of the debates I've had with myself and among the team is, well, how can we own, if you don't want to invest in Coca-Cola, how can you own a company that sells Coca-Cola, like Burger King? And I differentiate between owning a supermarket, which sells all kinds of stuff, some of which is healthy, some of which is not, to a company that's a pure play on something that I just don't support. So everyone approaches this issue in sort of their own way. But I think we can, act, and again, particularly because we're long term, right? There are companies that all of our companies are investing, Starbucks on improving their packaging, all the, Burger King, same thing. And there's a cost in, Chipotle, there's a cost associated with it. It will affect near-term earnings, but it will make the company more valuable over time. And since our holding period, we want to find things we can own, forever, in effect. We're happy for companies to make, investments now that help the world. One, because we live here, so we care. But also because we don't think there's any conflict with the long-term value of the business. In fact, we think there's a correlation.
I'm really happy to hear you say it, because I actually believe it very strongly that it's not an either or, right? It's actually taking care of the so-called stakeholders, the broader constituents, actually leads to better shareholder return.
I left off employees. Of course. If you have happy employees, they're paid appropriately for the work they do, are given access to good health care, opportunity for more education, the opportunity to run. One of the interesting things actually about fast food companies, they're one of the most, I would say, employee-focused businesses. Many of the people managing McDonald's today started at the absolute bottom of the chain. Burger King, the same thing. Domino's, same thing. The drivers that are delivering pizzas that become over time franchisees, and businesses where workers have an opportunity, to grow into the company, have more loyalty. People work harder because there's opportunities for advancement. So again, I've yet to find a conflict on a long-term basis, to make sure your companies are thinking about these issues correctly.
Yeah, that's great. One of the factors there, so the S, if you will, came into sharper focus in the middle of the pandemic. We had the George Floyd murder, and it felt like, again, a tipping point for a lot of conversations that have occurred, but maybe not at the right levels. Curious as to how your portfolio companies, and actually, frankly, how Pershing Square reacted to that. What did you see in terms of positive reaction, or in a sense, the best framing of the topic among your different companies and different leaders that you know?
I would say every board I'm aware of that has less diversity is aggressively trying to solve that problem immediately. And I'm chairman of the board of Howard Hughes Corporation. We brought on a more diverse executive who brings a fabulous perspective to the board recently. Tony Williams, former mayor of Washington D.C., and we're a company that builds these little cities. So what a perfect director! He's fantastic, and not just at the board level, but a much more serious look into have there been hidden biases in the way people advance through an organization in any of the companies that we're invested in. I would say every board around in America certainly is focused on those issues, and I think it will have a long-term beneficial impact. It's people are taking it much more seriously than they have before. Look, naturally, the same thing was true for women, right? You had businesses that were comprised entirely of men. Women came into the workforce. Gradually, law firms became more diverse. But corporate America's been, there's been this so-called glass ceiling thing. And, the interesting thing that's going on now, if you're a diverse candidate or woman or both, your job prospects have improved dramatically. And, there's enormous, finding, directors, more diverse directors is creating a lot of competition in a very good way. And I think that will have a very long-term impact.
Yeah, do you think, do you think companies are going to get a little more creative in how they do that? You know, I mean, again, you know this from all the boardrooms you've been in. It used to be just a bunch of ex-CEOs or near CEOs, which I don't necessarily think leads to better governance. And now we're seeing people go a little further into organizations for domain expertise and stuff. Are you feeling that too?
Yeah, I've always believed that. And here's an interesting thing, just from the activist perspective. When we were putting together activist slates, at the time we started doing that, it was more difficult to get candidates to sign up. And one of the ideas I had was to put forth an all-female activist slate. I wanted to do that for ADP, if you remember that one, a number of years ago, about 4 years ago. And it was really, really hard to get women to sign up to an activist slate because they were in such demand for boards, and they were concerned that being part of an activist slate might impair their ability to get on boards. I think that's largely changed. And someday, if I have another activist campaign, we'll make it the most diverse. I won't sit on the board. We'll just put up a really interesting, diverse group of candidates, and I think it will win hands down. And it will be a good move. It will attract a lot of attention.
Yeah, no, I couldn't agree more. One of the things, going through your annual report, I loved your description of your new SPAC, and I mean. 12 months ago, nobody, SPACs were a concept. I mean, it's actually an old concept. You and I have seen this movie before at a different level. I'm really curious as to what motivated you to come to create one, and then how you're thinking about the actual vehicle going forward in terms of not just Pershing, but the market in general.
Sure. So my first experience with a SPAC was when I was approached to invest in one about a decade ago. Was called Justice Holdings. And first time I read a SPAC prospectus, I read it because two talented entrepreneurs that I liked and knew, a guy named Nicholas McGroon and Martin Franklin, who was CEO of Jarden at the time, approached us about investing. And I really liked the guys, and I liked the timing. It was shortly after the financial crisis, but I hated the terms. I thought they were egregious, really. And so I told them, I said, look, they were trying to raise $500 million. I said, look, we'll invest $500 million, but you got to fix these terms. And I said, look, Bill, we're in the middle of the roadshow. We can't change this. So then I made a deal with them where we committed $500 million. And I said, we'd help them raise a lot more money because we're putting up $500 million and we'll become a co-sponsor. And what we want is just a third of the economics. We'll put up a third of the capital. And so we'll help you raise $1 billion of excess capital. And we ended up with just shy of $1.5 billion SPAC. We put up just shy of $500 million. And we gave our investors at Pershing the founder economics. So they were, in a way, investing without fees. And having $1.5 billion SPAC, which was the largest SPAC ever until the one we raised, circa 2010 after the financial crisis, was a unique animal. And it enabled us to merge with a company controlled by 3G on terms that made sense. And it's been a 20% compounded return for 9 years. So it's been a core investment in the fund for approaching a decade. And I said, look, this is a pretty cool thing. Someday we should do this again, but we should fix these egregious terms. And I put it, the back of my mind, and said, let's wait for the next time, like a financial crisis, when an entity like this is going to be most valuable, because we're finding plenty of opportunities. It's a lot of work. Let's not do it until it makes sense. COVID hits. First thing we do is we hedge COVID risk. The second thing I do is let's think about how to design a structure that solves the problem we took up SPAC. And that's where we came up with a unique structure. And we had this, incredible response. What's interesting is you design something that's extremely investor friendly, merger friendly. People get it. We had 12 billion of demand by the second day of the roadshow. And I, capped it at 4 billion, no green shoe. And then we picked the investors we wanted. We're now working on some interesting things, which I'd love to be able to talk about, but I can't. But I think our original premise will ring true. The one thing I didn't expect is the strength of the IPO market since we launched the SPAC. It's been spectacular. I was expecting a more challenging time for companies to go public. It's starting to smell to me like that times are a-changing. NASDAQ is, for the year now, NASDAQ is only up, a little under 2%. Another bad down day today. So the value, a lot of these IPOs have, in some cases, fallen below the IPO price. So I think SPACs are here to stay. I still think the structures leave a lot to be desired, the typical SPAC. But I do think they're providing access to capital for companies, and I think that's generally a good thing. The issue is SPACs have a huge advantage versus the traditional IPO. The SEC is extremely strict when you're going public in a traditional IPO, and you can only talk about the past. Last quarter, last year, you can't say in 3 years we're going to generate, $10 a share of earnings. SPACs can do that because they're considered merger transactions, and the result is that a lot of very, very speculative companies with zero revenues. There's this Lordstown thing. I don't know if you've been following that at all in the press today, but it's an electric truck company that claimed to have 100,000, on CNBC, 100,000 serious orders. And today the CEO admitted that, no deposits, and the guys at Muddy Waters or Hindenburg Research, I think, did a very, very good job explaining why they don't really have any real orders. And so I think the risk of investors being defrauded by this Nikola truck one, I'd probably stay away from the electric truck versions of SPACs. The difference, what we're trying to achieve, and I think we'll be successful, is to buy a great business, that meets all of our criteria. That we don't have to wait 10 years for the business to generate profits. That's a super durable growth company, and we're a $5 billion equity check is a unique entity, and allow us to, we don't need to make any promises about, that the company's going to earn money in a decade. We're going to buy a great business at a price that makes sense, and I look forward to being able to talk about that deal. Looks like you froze, Bill. So maybe Jonah, you go to a question while we're waiting for Bill to cover.
Awesome. Bill, continuing on the discussion of SPACs, as Pershing Square Tontine Holdings is currently the largest SPAC in the market, what are the positives, as in what drew you to the space during the market crash in March? And what should investors expect, and what should they be wary of?
Sure. I think I largely answered that question. So why don't we go to the next one?
Okay, then the next one is from Eileen Mage.
Go ahead, Eileen.
Okay, while we're waiting, I can ask another one. So, Bill, this pertains to the proxy battle with Canadian Pacific Railway. In 2009, the company was awarded for its practices in corporate governance. How did you go about identifying the board of directors' weaknesses, and what made you so confident you could turn around the business and create so much value for its shareholders when the board described your goal as a shot in the dark?
Yes. So, unfortunately, some of these governance awards are given for reasons that have nothing to do with good governance. So, this was not a particularly well-governed company. It was a really, really poorly managed one. So on every metric, if you put them next to Canadian National, which had been run by Hunter Harrison, who was our CEO designee, the company was, in the bottom decile, and Canadian National was in the top 1%. And so, it was just flat out black and white obvious. The board itself was a very clubby, important group of people in kind of the high ranks of Canadian society. And so the notion of a New York hedge fund coming in and telling them what to do was not something they were particularly receptive to. And it actually took us some time to put together a board slate because a lot of people didn't want to go up against the Canadian establishment. And a woman by the name of Rebecca McDonald, who herself had gone up against the Canadian establishment, was my first director. She was the first person to take a Canadian company public as the CEO, as a woman. And so she wasn't afraid of the establishment at all. And once I got her, we recruited some other directors, and then we just explained the facts to the public. And we got 99% of the vote or some crazy number. And that was it's a great story. My only mistake there, we paid $46 Canadian for the stock, and today the stock is $480. This is a railroad, right? We invested in 2013. So in 8 years, the stock is, it's like a Google, right? And some people consider it the greatest industrial turnaround ever, but I didn't have permanent capital. We were going through a challenging period in the firm, and I sold the stock for $180, $190 a share. So we left a lot of money on the table. That's not going to happen again. So.
Thank you. Our next question is from Robert Harrison.
Does someone have to unmute Robert Harrison, or does he do it himself? How does it work, John?
I got it. I'm unmuted.
Okay.
Hey, Mr. Ackman. Thanks for coming. My question is, when Pershing was experiencing the drawdown, how did you keep your team engaged and driven? How did you prevent your best team members from jumping ship and going elsewhere?
It's a great question. And, as I like to say, life is not a straight line up. And, the most successful people I know have gone through a challenging time. And, one of the things I when I speak at a place like Wharton, I'm talking to the best and brightest, and they're 24, 25, 26 years old. And the problem with the typical Wharton student is to get into Wharton, it means you did really well in high school, graduated something close to the top of your class. You went to a really good college, if not Wharton as your undergraduate program, and you haven't made a mistake yet. And I would say the single most interesting to hear, Bill agrees with me, but I would say the single most important thing you need to understand in order to be successful is you need to be able to manage during the times when you're not. And that means when you failed, and that means when you got fired, or that means when you go through a challenging health issue, or your wife or partner or parent does. I mean, life is going to hit you like a ton of bricks with something, and it probably hasn't happened yet. But how you deal with that will affect your ultimate kind of life trajectory. And so I've had a couple of challenging periods in my career, so I'm really good at it by now, I would say. And I like to say, when I turned 54, I said, okay, no more, I'm done making mistakes. So we'll see how long that goes for, but I'll probably make another one. But what I will say is, the culture is not something we talked a lot about at business school because it's so intangible. It's hard to understand. But you come to realize what holds an organization together is its culture. Yeah, compensation matters, incentives matter enormously. But do people view themselves as part of something greater than themselves? Do they feel like they're part of a team? Are you prepared to go to battle together? And that's kind of the organization that we built. But we did have, a number of people decide to go on to what they thought were greener pastures. A member of the investment team left exactly 3 years ago in March of 18. I was disappointed with him, super talented guy, Wharton valedictorian, actually. And he left at the absolute bottom. And what I did to make sure that no one else did is the people who were prepared to stay during this challenging period. And again, in our business, when you're down 30% from the high water mark, or whatever, maybe more than that at that time, it's a 50% climb before you get any incentive compensation. And we had redemptions from investors. But we had something, unique, which is we had permanent capital. Fortunately, I did something I'd never done before. I borrowed $300 million from JP Morgan. And I had some other resources, and I bought $520 million worth of stock in our public company, Pershing Square Holdings. And thank you, Jamie Dimon, for approving that loan. I think it was the largest unsecured borrower of JP Morgan, and they lent me the money at the bottom. And I used that to buy that 25% stake. I only had a 4% stake before that, and myself and other employees bought a stake. And that cemented in. We now were the controlling shareholder of Pershing. So I told the team, we are better positioned, March of 2018, down 35% or whatever we were at the time, than we ever were. And then the other thing I did is, I'm good at sharing. Okay, so I said, look, this thing turns around, you can do really, really well. And I gave, everyone already had meaningful, the key personnel, members of the investment team, other team members already had equity in the firm. But I used the equity, I widely dispersed equity around the firm so that if and when we recovered, they would do very well. The other thing I did is, of the stock I bought myself, I gave a promote on those shares to the team. And so they could participate from there until we got back to the high water mark. And I assumed 100% of that cost, if you will, even though I don't own economically 100% of the firm. And, there are members of the investment team that made $100 million last year. There's, numbers like that. Okay, so, and these are people who are, went to Wharton, 150 million, huge numbers, and they earned it. And, I'm a huge believer in rewarding loyalty, and what a great opportunity, this turnaround. And now we're incredibly well positioned. Our public company has $10 billion of equity. and no one can redeem. So the capital just compounds. Here, and I'll show you one of the other things I've achieved in the last 2 years. Sweetheart, come here. Hold on. What's happened to you? Come here, sweetheart.
What happened to you?
Okay, how cute is this? Say hello. Say hello to 715 Wharton students. I highly recommend that you engage in the activities that led to her creation. I'm sure Wharton students are aware of that approach. She's got little hearts on her. Hi, sweetheart. So, say hi, and then I'm going to let you go back to mommy because we got a little Q&A going. Yeah, you can ask her a question. She's in a spark. By the way, the advantage